It's a fairly common perception that C corporations are tax disadvantaged from a double taxation perspective. To really understand this statement, I think you have to look at C corporations from both an operational and a transactional perspective. From an operational perspective, C corporations really become tax disadvantaged when the net income or earnings of the C corporation outpace the owner's ability to comp or bonus those earnings out. At that point in time, that excess taxable income typically has to come out in the form of a taxable dividend to the shareholders. And so you've got double taxation. You've got first layer of taxation inside the C corporation on the net income, and then a second layer of taxation on the distribution of the dividend to the shareholders. From a transactional perspective, C corporations create this natural tension between sellers and potential buyers of the C corporation. Sellers of C corporations typically want to sell the stock of the C corporation because that's easiest for them, and it affords them the best tax answer typically in the form of long-term capital gains on the disposition of the stock, assuming they've held it for longer than a year. And it's not uncommon that buyers want to buy the assets of the C corporation for a number of reasons, both legal and tax. From a tax perspective, buying the assets of a C corporation affords the owner the ability, or the buyer the ability, to step up the basis of those assets to a new fair market value amount and then start amortizing or depreciating that increase in basis. Those additional amortization and depreciation charges can then be used to offset future taxable income, and from the buyer's perspective can significantly increase the net present value or internal rate of return associated with that acquisition. But an asset acquisition by the buyer creates certain problems for the seller if he can't sell the stock, because it creates that double taxation issue again. Because a C corporation on an asset sale is going to have an internal gain on that disposition, pay tax on that gain more than likely, and then turn around and have this net cash position that it needs to distribute out to the owners of the C corporation, the sellers, and they're going to recognize dividends or capital gains on that again, so that same income's been double taxed. And it's not uncommon for the combined tax rate in an asset sale of a corporation to be in excess of 50%. And so what's the takeaway from all of this? If you're in a C corporation and you're thinking about that there might be a transaction in your future, realize that this natural tension between you, the seller, and a potential buyer may exist. If you're just starting a business, realize that this tension's out there also, and maybe opt for another alternative business arrangement, maybe operating as a limited liability company initially. It's always fairly easy to go from a limited liability company to a C corporation if you need to, but once you're in a C corporation, it's difficult to get out of that.